Hey, fellow stock guardians, happy Thursday, June 3rd, 2021. I'm Hoda, StockCard CEO, reporting to you from a red stock market. I took a look at the new jobless claims report, discussed whether Workhorse Group can survive despite the USPS project denial, and dug into whether it's an excellent time to buy the dip in PagerDuty stock. All three indices finished Thursday in the red despite the better-than-expected new jobless claims report. Less than 400,000 people filed for unemployment claims this week, which is the lowest number since the start of the pandemic. Investors are now waiting for May's employment report to come out tomorrow to confirm that the economy is indeed on track. Shares of Workhorse Group, WKHS, were up more than 19%. Although the recent price jump is mainly due to the short squeeze rally, there might still be a path for Workhorse to survive. I spoke with one of our analysts, Felipe, who is conducting extensive research on Workhorse, and he provided some interesting insights. It seems the company is coming up with alternatives to its highly anticipated but denied USPS contract. For example, Workhorse has entered new partnerships with UPS to supply delivery drones. Moreover, the electric vehicle maker closed two important deals recently, including a purchase order for 6,320 units of its C-Series vehicle that would generate more than $300 million for the company until 2026. Although the USPS contract denial was a significant issue for the company's future, Workhorse built a solid alternative for its survival, it seems. As soon as Felipe is over with his research, we plan to give you a comprehensive Workhorse stock analysis. Stay tuned. Aside from most short squeeze stocks that ended Thursday much lower than where they landed yesterday, PagerDuty (PD) shares were down more than 10% and grabbed my attention. It's a surprising drop because the company's earnings report was quite solid. Revenue was up more than 28%, and customers with annual revenue above $1 million were up 55%. Those are key numbers when you sell enterprise software and show more clients are trusting the services and product enough to spend at least $1 million on the company's products and services. It seems investors are spooked about the wider losses. When I dug into the reasons, the wider loss is primarily due to higher marketing costs due to a TV advertisement campaign and change in the timing of the company's annual summit and the cost associated to the summit. If you look at the company's stock card, its revenue is expected to grow rapidly and it generates free cash flow despite being an unprofitable operation. I own a few shares and I believe it's a beaten down stock worth owning if you are comfortable with tech sector's volatility these days. That's it for today. If you haven't already done so, please give StockCard a try. Research as many stocks and ETFs as you want, and consider following a few successful investors by visiting the Stock Pick page on the StockCard platform. And don't forget to sign up for the 14-day free trial with promo code ROLLWITHOURCEO, all lowercase and in one word. And lastly, but not least, please help us grow the StockCardian community by liking, subscribing, and sharing these daily market recap reports with your fellow investors. You know how these algorithms work. We need you to give us a thumbs up so that we can grow the community. I'll see you tomorrow.